I can also hear. Okay.
I'm seeing.
All right. Well, we'll go ahead and get started. Thank you guys all so much for being here tonight. I know I'm really excited to learn from this panel tonight on alternative capital in uncertain times. You know, I experienced last year in 2021, it was a record year for VCs. And then Q1, we saw the same trend going into it, but that drastically changed when we came into Q2, where investments dropped by about 23%, I believe. And so with that, it creates a lot of uncertainty, and there's a lot of factors for that. We have inflation, rising interest rates, geopolitics involved. So I know I'm going to have a ton to learn from this awesome panel here. But before we get into it, I have a couple of housekeeping things that I want to bring up. First, a shout out to Founders Live. They are streaming this event for us, and we'll be providing the recording for everybody after the event. So you'll see another email coming from me with that link. But if you guys don't know about Founders Live and who they are an entrepreneurship and founding community, and a global community at that. So they started here in Seattle from Nick Hughes, and I don't know where Nick is at in the crowd. Oh, Nick's over there. So if you don't know Nick already, you should get to know him. But he started the community here in Seattle, and it was a pitch competition. 5 companies had 99 seconds to tell their story, and then the crowd gets to vote on it. Well, it grew from the little thing that it was here in Seattle to over 35 countries across the world, and a real community for people and resources for them. So if you don't know them, don't know about it, come find me, come find him. Love to get you in touch with that. So secondly, we are going to be kind of taking questions throughout. I'll take kind of breaks throughout the conversation for you guys to interact with the panel. I would really love for it to be interactive. So, all right. So without further ado, let's get into meeting our panel. So I will start here with Kelly. Tell us a little bit about who you are and what you do.
Hi, everyone. Very happy to be here. My name is Kelly Lawton Abbott. I'm an attorney with SSM. We are a women and minority-owned law firm, started in San Francisco, and I am leading our Seattle office. And so we work with early-stage startups and small businesses and provide everything from incorporation, support through financing rounds, and then act as general counsel to help on the daily things that businesses need.
My name is John Fleming. I'm at CIBC Innovation Banking. Just opened up the office in April. We're moving westward, so we're expanding across the country. We focus on providing debt, growth capital to early all the way up to later stage and buyout. Our sweet spot is a growth stage company, typically 10 to 15 million committed. And we really follow the investor community. We're focused solely on software companies. So really like to see recurring revenue and year-over-year growth.
Thanks, John. My name is Owen Carton. I'm Irish. I was working at Microsoft for the last 10 years, and then I took a couple of companies public on the stock exchange, NASDAQ, and I worked as a VC in the Bay Area, multiple VCs, and I've worked for my own company since. So I have a lot of practical experience. So I'm working now with CFO.
Awesome. Pumped to be here. My name is Cameron Bormond. I work at a firm called Fuse Venture Partners. Myself and my 2 partners spun out of our previous firms in 2020 to raise Fuse. Myself and my partner Kellen were at a firm called Ignition Partners here in the Pacific Northwest. Ignition was founded in the early 2000s, ex-Microsoft and ex-Macaw Cellular folks, and really invested for 2 decades, primarily in enterprise software. And that's the vision that we had, is continuing the legacy, backing and finding great early stage founders in the Pacific Northwest at the pre-seed, seed, and Series A. So we'll invest anywhere from $500K to $12 million into these companies. Since raising our Fund 1 in 2020, which was $170 million, we've backed 27 companies and are now investing out of our second fund as well. So it's been a lot of fun. This ecosystem is we think the best in the world for enterprise software and AI, and excited to be here and share more.
Thank you, guys. All right. So I want to start off with a market update. Kelly, can you tell us about the current market stats here as of Q3?
Yeah, so I think one thing that we're really seeing is that overall funding globally is down, but this is really a market correction. 2021 was a boom year, the biggest ever that VC financing that startups had seen. And so we are correcting that. So some of the stats that I want to share with you. So globally in Q3, startup funding was at $74.5 billion. That's down 34% quarter over quarter, and down 58% from the 2021 peak. When we look at the US data, it's down 32% quarter over quarter, so just slightly less than the global decline. And there was 36.7 billion in Q3, close to half of the global amount. There is an increase in deals. There were 68 more deals in Q3, so it was up to 2,866. Then when we look at Seattle, there's actually some good news there. Funding increased to $2 billion in Q3, and there was 88 deals, which was the second highest quarter in history. So that's kind of where we're seeing that market correction happening there. The other thing I wanted to share was looking at women-founded companies. So there was a big realization a couple of years ago of how little representation there was in women-founded companies. And so year to date for 2022 exceeds 2020. We're at 32.4 billion. And then the deal count for 2022 is expected to see 2020. So we're not at the 2021 levels, but I do see some improvement over time, which is great to see.
Yeah, makes me really happy that we're in Seattle. So next, Owen, I want to talk to you about your current clients. Are they raising money right now? And if so, where are they finding that capital at?
Okay. So one of the big issues is you need to look at non-Series A, Series B, Series C, seed. You need to look at, are you pre-product? Are you pre-revenue? Are you post-revenue? Are you profitable? So that's going to dictate where you go for the capital. And you need to focus on the segment that you are. And now there's lots of capital for lots of segments, but don't think in terms of Series B or Series C. Think in terms of pre-revenue or post-revenue or profitability.
Yeah, thank you. Okay, so Cameron, I see the wheels turning over there. So can you tell me about how the deals in your firm are doing this year and how they've changed, if they have changed at all?
Yeah, look, I think whenever times change like this, you have to meet with every founder and every company to really understand a few things. One, growth. Where are we at growth-wise? Typically, venture-backed companies, you want to triple for the first few years, and then after you hit, call it $10 million, you want to continue to double thereafter. But more important than growth is how much cash are you burning, and how maybe do you think about extending runway? Are there certain cuts you need to make? And so we put all the companies in kind of these different buckets. If you're growing fast and have a ton of cash, then you're obviously in the best spot. If you're growing fast but getting low on burn, that's a conversation that we need to have. Luckily, you're getting significant pull in the market, but what are the other capital sources out there that you should start exploring? When's the right timing for that? Then there's other buckets like not growing fast, don't have a lot of money. There's a lot of companies that have been funded over the past 3 years during a bull market, and with the assumption that the next round of capital will be there. And now, the goalposts have shifted back significantly. And so if you're a pre-product company and think, okay, I got to build a product, I got to get 5 design partners to go raise that next round of funding. Now it's not 5 design partners, maybe it's 15 real customers, paying you actual revenue. And so for us, the first thing we did is just have those conversations with our founders, and based on what else we're hearing in the market, and try and get everyone on the same page and realistic. Because what you don't want to happen, and what typically happens with a lot of folks, is say, well, my buddy just raised at this price 6 months ago. You know, we hear a lot about that from the companies that we're talking to, and I think there's going to be carnage that comes over the next 6 months, but that mentality is changing fast given the public comps. You know, the public comps and the SaaS multiples are down by over 2/3. Some companies are down by, really 90% since their highs. And so that's what the growth investors underwrite to. They underwrite to the public SaaS multiples, given they're down by 2/3. Growth investing, theoretically, the multiples they pay can come back down by 2/3, and that will continues to trickle down in the early stages where we invest. But that's all the negative. If you're a company that has a great product, you're selling it, your customers love you, you're growing, and you have the cash, we don't want companies to necessarily overcorrect. Prepare for the worst. A lot of very smart people are saying there's a recession coming. I don't know. I'm not a public markets investor. I don't pretend to time the markets. But if you can grow 3x, growth still matters, as long as now you're doing it in a capital efficient manner.
Thank you. So, John, given that there are lower valuation and multiples, how have investors and potential borrowers changed their thinking about debt financing? And if you could provide us with a few examples of that.
Yeah. So the way that in this environment, we're senior bank debt lender. So we're not going to take as much risk as some other lenders in the market. So what we want to see is companies that have some liquidity. In this environment, companies are going to be reluctant to raise equity because they don't want to take the valuation hit. Maybe they had a big valuation their prior round, and they've got to meet that. They've got to get a higher valuation when they raise again. And markets right now just aren't conducive to that. So debt is an option for them. For us, we want to see that they've got enough liquidity to weather the storm. What we'll do is we'll come in and extend the runway of that existing liquidity. If liquidity starts to deteriorate, we may not be the best fit. There are other options. So a venture debt firm might be able to take more risk. Of course, there's trade-off. With us, we're going to be more structured. We're going to have a couple of covenants. We're going to have some guardrails. Where a venture debt firm may have less, they're willing to deal with the fact that a company has less liquidity, but they're going to be a lot more expensive. And they might also ask for a little bit of equity in the form of a warrant. So companies now, if they're reluctant to raise, debt is, in some cases, maybe their only option. So it just depends on the situation.
All right. So I'm going to take a quick pause. Does anybody have questions up till now about market update type of stuff? Nope. All right. So we'll move on to raising money in general. So Kelly, to set the parameters for this, can you tell us what you are seeing as far as people raising money in startups for pre-seed, seed, and Series A rounds?
So these stats have stayed pretty stable, but what kind of giving you the framework for it? So at the pre-seed seed round, this is when companies are raising money from friends and family, angel round. These are typically going to raise under $500,000 as part of that round. Then when we move on to the seed stage, these rounds are between $2 million to $10 million. And so historically, if a company was raising between $2 to $3 million, they would be done via safes, and anything over that would be done doing a Series Seed preferred round. Now we are seeing more startups doing a kind of larger than 2 to 3 million through safes, but I'd also be interested if Cameron has any context on that as well. And then on the Series A, that's going to be 10 million and above, and that's going to be for a purchase of preferred shares.
Yeah, Cameron, did you quickly want to add anything in there?
Yeah, I think I think you'll start to see a lot more down rounds. I mean, particularly in the growth markets where people are investing between, call it 15 to 35. We're talking to a lot of our peers that are saying, yeah, we're only doing either flat rounds, So the same valuation that they raised at a year or two ago, or down rounds with some sort of structure, whether it's a liquidation preference or some other type of structure. And that the growth markets are where a lot of the carnage will happen over the next few years. I mean, on average, looking at the math, these companies will need about 2 years to grow into the valuations that they raised at 1 year ago. And so what does that mean? If you're a board member of the company or the CEO, do you cut your valuation now? Well, if you do that, some of the top talent in the organization might leave. Do you continue to stay course, keep your valuation at where it is? Well, it might be hard to raise additional capital from new investors, especially if your early investors don't want to continue to put money into the business. So there's a lot of trade-offs that'll be made over the next 2 quarters. Some of that you're starting to see happen this quarter, but at the early stages, I think Kelly's spot on. Companies can raise safes, preferred rounds. We don't have a strong preference. Eventually, it's good for the founder to know how much of the business they own. It can be a little tough when you raise at multiple safe rounds to understand how much of the business you own as a CEO, but good companies will continue to get funded.
Yeah, thank you for that. So, John, why is it important for startups and founders to be working with a startup bank like yours? What are the additional benefits that you can offer them, especially whenever they're going out and raising money?
Well, if you're in the tech space, you want to be with a bank that knows the space. A lot of times, companies will just open an account at a local branch just because it was convenient, only to find out later that that bank doesn't know the space. They're not connected. They're not going to give them any special products and services. What early stage companies want, because a lot of times they haven't raised their first meaningful round of equity, is they want low priced services, and that includes banking. So they don't want to pay for it. So one of the things that a venture bank can do is offer bundled low price services with the hope that later, when the company starts to scale, raises more equity, they're going to be rewarded for that. The other thing companies want is they want a bank that's connected. So if you're out raising a round, they want to know that your banker has experience in the space, knows a little bit enough about your company so they can introduce you to investors that would be interested or have expertise in your product or service. So for instance, the company came to me and said, we're an AI software company in the industrial space. I was able to make some introductions through my peer network with investors that were interested in that space. No disrespect to other banks that aren't in the venture space, but they wouldn't be able to do that. So a lot of times, those switching costs of having to move banks because it's not the right fit is time wasted. So venture banks and the usual suspects, Bridge, SVB, Avid Bank, Signature, JPM, CIBC are all good banks to start with.
Did you have something you wanted to add there, Owen?
Yeah, I wanted to add something. We've been talking a lot about post-revenue companies, and there's pre-revenue companies, and there's startups. My colleague Kelly talked about startups. You can focus on angel funding. You can focus on family office funding for startups or pre-revenue. Both of those guys are spending their own money. So when you get institutional venture capital, typically they're spending other people's money. Limited partners are providing the money to these institutions. So that's fine. But some of you may be earlier than revenue. And for that reason, you want to talk to angels, typically about 500K. Family offices, it can go up to 10, 12 million. And that's pre-revenue as well.
Yeah, no, I'm glad that you mentioned that. So actually, Owen, whenever you're meeting with your clients, are they looking for alternatives to VC funding, particularly because of the downturn or economics, like inflation going on?
There's a lot of really looking at crowdfunding. So there's a crowdfunding opportunity called Start Engine. And this was featured on Shark Tank recently, and it was specifically for companies that are pre-revenue. But on crowdfunding, you can raise up to 11 million. So I was against crowdfunding in the past. Now I'm for crowdfunding because of Start Engine. But there are many others as well.
Well, thank you for that insight. So, Cameron, I want to kick it over to you. So, pundits are saying that venture funds have plenty of dry powder to invest in startups, but others are saying that based on dated information, that might not reflect the reality of things. So, what is your take on it?
Yeah, I think the venture funds have capital. One of the things that we're thinking about is, particularly again at the growth stage, how much of that capital is being now reserved for existing investments. The scenario I explained earlier where you have a company that needs to grow into the valuation. Do you now increase your reserves ratio different than what you would have because you need to support these companies to just even get to their valuation that they were at a year ago? And so I would say the funding is happening. It hasn't stopped. Investors, what I find now, there's less FOMO. A year ago, the FOMO was bad, and the processes were a week or 2 weeks. The founders ran very tight processes. The capital was flowing very quickly. The founders were coming back to market very quickly because they could, and so they'd raise a seed round, and then they'd go out and raise their Series A 3 months later, or they'd raise their Series A, especially if they got it from a great brand name firm. Then they go raise their next round because they could. All that has really slowed down, and so the companies are coming back to market way less. Investors are focusing a little bit more time on their existing portfolio triage. That's why you saw a lot of this slowdown over the past, call it 3 to 6 months. I do think it'll start to pick back up in Q1, and at least that's what we're hearing more broadly. But I think everyone was kind of like, okay, that was a lot these past 2 years. I need a mental break. I need to make sure my portfolio is okay. And then the startups partly needed the same to understand what was going on in the world. And then hopefully things start to not get back to normal, because the last 2 years was not normal, but get to more of a consistent pace, given the venture funds do have capital to invest.
Right. I don't what is normal these days. So, so it's hard to tell. So I'm going to move into our next session, which is additional capital to extend the runway. So a lot of clients are in need of additional capital to bridge crowdfunding to their next round, but want to avoid downturn. So how we're going to go about advising them. So John, I really want to take the next question over to you. What is the most important to you with your clients as you look at new opportunities? What are the requirements for you to lend?
Well, the most important thing for me is growth. I want to see that companies are continuing to grow year over year. That's usually going to be one of my covenants, year over year growth. And the next thing is going to be liquidity. How much runway do they have? Because I don't want to be the last money in. Again, I'm not getting paid equity returns. I'm not getting paid venture debt returns. I'm getting paid senior bank debt returns, which are not that great. But I make my money elsewhere. I make my money in a relationship, so I'll make money on deposits. So we don't want to take a whole lot of risk. We want to take some. Companies don't have to be profitable, and they don't even have to forecast that they're going to be profitable in the next 2 years. We just want to see that they're going to be growing year over year, because that's going to attract more equity capital. And if more equity capital is coming in, that means more liquidity is going to be coming in. So that's what's important to us. There are alternatives for companies that are earlier. Typically, venture debt funds have been, their minimum check sizes historically have been probably 5+. There are venture debt funds now that are catering to the smaller end of the market. Let's say it's a company that's generated some revenue. They still haven't raised their first round of institutional capital, but they've got a business, real business. There are venture debt funds, a couple in the Valley, that are investing in or lending to companies like that, smaller amounts, but it's an alternative to the traditional venture debt funds that typically don't want to get involved until it's at least 5 million, maybe even north of that. So that's another source of capital for companies that haven't raised their first meaningful institutional round of equity.
Yeah, thank you. So Cameron, to kind of piggyback off of that, is this only going to be available for the best companies in your portfolio?
I think I'd leave that up to the providers of debt. What I will say is that we're constantly telling them to explore, what is the optimal capital stack for the business. Equity that you're selling to investors is expensive, and venture funding, I think a lot of people look at it and think, oh, there's all these news articles. Oh, I got in TechCrunch, I'm in GeekWire. They think venture funding is synonymous with success, which is absolutely not the case. I mean, if you're the founder of the business and debt makes sense for you, you are going to own way more of this business at the eventual outcome than you are if you raise venture funding. And this is not, this is the opposite of self-serving, because, obviously we want to chat with you, but it's always worth exploring and talking to the pros like these folks to understand, okay, at what stage would debt make sense? Is it going to put too much strain on the business, or is it going to give me a little bit of extra runway to hit the key milestones I need to get to a successful outcome? In that scenario, that I'll own way more of the business than if I raised $10 million of equity in that scenario. So we're always exploring our founders to look into it, not just reserved for certain subset of companies. We always make sure it won't put too much undue strain on the business, but that's a math exercise that folks like John are super helpful in conducting.
I wanted to ask, by show of hands, who is pre-revenue, so we know who we're talking to? Is anyone in the audience that's pre-revenue? No? Post-revenue? Okay. And pre-product? Your startup, raw startup? No? Okay. So mostly you're post-revenue, and EAs, early adopters, are going to be very important, both for capitalizing the company and for evidence that your product is in demand. So focus on the EA opportunities for your company, and also put together obviously the thesis for your company. Do you know what thesis is? You need to have an IDC, inflection, differentiation, and catalyst thesis at every stage of the company. So it's a PowerPoint presentation. But if you want to focus on that, put together that for capitalizing the company.
Yeah, actually, would you mind expanding a little bit on, the messaging that lower performers are going to want to put into those types of decks?
Lower performers, there's nobody put their hand up.
Yeah.
Lower performers are not going to, they're going to focus on angels and family offices, as well as basically crowdfunding is for post-revenue as well as lower performers. But I don't think that's relevant here.
Awesome. All right. Well, Kelly, what are some of the legal considerations that they need to have?
So a lot of this conversation does come down to startups talking with their CFOs like Owen. But the three things that I would say that we're seeing from our startup clients is, one, the startups are going back to their investors to ask for more money because they're not ready to go into another round. I think that is one thing I've seen companies who say, hey, I'm ready. And they thought they were going to be ready for a Series A, and they're not. And they want to maybe avoid that down round. The other thing, kind of combining that, is raising money through safes to bring on that capital that would then convert at that next round that they do. And then the other thing is decreasing their workforce. And so providing alternative forms for employment. There was a huge layoff. I think 3 months of this year, there was like 80,000 tech employees laid off. So that does kind of trickle down to the early stage where people are making those different decisions so they can extend their runway.
All right. So I know we have thrown a bunch at you guys. Does anybody have any questions up to here about raising money or extending their capital? Yeah, back here.
Okay, so question for context on, so I work with startups and often they're battling with, do I want growth metrics or do I want to be profitable, right? So just maybe speak to that going into an unknown economic space, and is that different from being in a good space?
Yeah, it's a good question. I mean, it's a fairly company dependent, so I hate saying it depends, but if you're a business that has early product, that has product market fit in a very big market, and you're sitting there thinking, okay, I think there's a very large multi-billion-dollar outcome here, and I want venture funding plus, some debt to be the path to get me there. The dirty little secret is everyone's saying, cut your costs, cut your burn, and be focused and disciplined, which is 100% true and accurate. But if you're not growing, 3x early on and then 2x after, it's going to be really hard to get that venture funding. And so if you're able to see a clear path to doubling every year, if you're past the $10 million of ARR, or tripling if you're, between 1 and 10, then, I would say go for it and focus on growth, because if you're in that stage where you're growing 1.5 to 2.5x, and it can just be harder to raise that additional capital. Now, that's the very few, that's the minority of a small percentage of the companies out there. For most companies, if you have revenue, you're maybe doubling every year, growing 50 to 70%, and you see a path to profitability, and you can easily get there by making a few changes to the business. Absolutely. Or maybe you think about, hey, do I extend runway with a little bit of debt to get there? Absolutely. Especially if you're not in a market where you think this outcome is going to be a $1 billion plus outcome, then, absolutely, 100%. So it's a little bit of a depends, but if you're in that minority, you still gotta go for it, or else you're not going to be able to raise capital either way.
Thank you. And I think we have a question here in the back.
Thank you. I want to deepen something you mentioned about you don't have to be profitable, but have to have a line of sight for growth. So does it matter how much money you make versus what clients, how repeatable your sales are, do you have extension revenue? How much is the raw amount of I have 3 million in sales versus the kind of customers or the adopters I have? How does that play out?
From the standpoint of raising additional money, or, it depends, again, what stage you're at. But for us, the biggest thing is how happy are your customers early on? That's the number one thing we underwrite when we invest at the seed and Series A. If you have a subset of companies, we'll go talk to them, and they say, hey, this product or service is the greatest thing since sliced bread. Here's how it's changed our life. We'll then go take those stories and underwrite it to our customer network to say, okay, is it repeatable? Maybe we'll make introductions to the founders, to these potential customers, and then use that as a form of getting diligence to think about, do we want to invest in the business? So number one, I'd say the value that you're providing your customers, how they talk about you, is it repeatable, is the most important early on. Now, in the later years, you want to figure out, hey, is the gross profit there? Do we need to make changes to how we're delivering this? But yeah, focusing on customers is always, I think, the best course of action.
Yeah, John, you want to add something there?
Yeah, I would say from a debt standpoint, so we look really at their software metrics very closely. So kind of piggybacking on what Cameron said, we look at retention rates. So if they have high retention rates, that means their customers are renewing year over year. Customers are staying with them. So the quality of that revenue is very high. Conversely, how many customers are leaving? What are the reasons that they're leaving? Are they leaving because the product's inferior, or it's obsolete, or they've gone to a competitor, or are they leaving because they've gone out of business, which is something that's not controllable? So those are the factors that we look at in addition to growth. So software metrics are very important to us.
Awesome. And I think I saw one more over here.
Yeah, my question is just maybe for groups that maybe you don't have an existing relationship with already. What has changed in your diligence period from, say, the last couple of years, where it's very from, or even like pre-COVID to now, kind of 2020, end of 2022 and beyond? What you're looking for groups that are looking to get that first seed or Series A?
Yeah, I think for us, on average, we know our founders for 19 months before we invest in them, and that was even over the past few years. With that said, there were scenarios in which it's a bit more of a fire drill. You're seeing less of that, but we're a bit odd in which in that we focus on this region, and so shame on us if we haven't got to know the founders, and that's just not when they're fundraising, but actually get to know them as people. Go to lunch, go to dinner, understand what drives them. Know about their families, get to know them as people, and so that's been a bit of our edge over the past few years, where a lot of the world has moved into the just-in-time investing. Get a deck on a Thursday, have to make a decision that next week. That slowed down a little bit, and I think it's healthy. I think right now there's a lot of companies that we're talking to that really didn't get to know the person that they added to their board. And on average, your board member is on your board for 8 years, which is longer than the average U.S. marriage. And so they can be a huge pain in the butt if you don't take the time to get to know that person. And so I think it's a very healthy, from a, hey, I'm going to go do a quick process and a round and get the money in and go back to building my business, to thinking, okay, this is a partner, a true partner to the business that I should spend the time and get to know before I, take their capital, because sometimes that capital can come with a whole lot of pain if they're a bad personality around the table. We're seeing those stories right now.
Okay, one of the things that I wanted to add was that you need to look at dueling term sheets from investors. When you get one term sheet, you're kind of stuck with what the terms are, and when you get dueling term sheets, you can go back to the whoever has provided the term sheets, that's your preference, and say, well, this would be good if. So the other thing is to focus on, don't focus on valuation. Give a discount. That's important. You focus on the valuation, what it would be if the company was, if we weren't in the economic malaise that we are in. So give a discount off of that valuation. To my colleagues here are looking for equity. My colleague is looking for equity, but you aren't. So it's really important to have the company survive. That's really important. And so have a discount off the valuation. That would be preferable to taking it in the shorts, so to speak.
Yeah, thank you. That actually is a perfect segue into the next topic. So, what impacts are valuations having on earlier stage companies versus growth stage companies? And so, Owen, I've got my favorite type of question, is financial question. Okay. So, there are 3 financial items that are fundamental in play when securing a round of capital: valuation, amount to raise, and percentage of equity. Of those 3 items, what are the effects of valuation right now, and how would you compensate given the climate, if at all?
Okay, I would compensate based on the discount. If the valuation is not what you want, give a discount off the valuation. That's how I would compensate on the valuation at the moment. So you might need to give a greater discount. Okay, it's important that the company survives, and the valuation isn't that important. 10 million or 20 million in valuation isn't that important. When you're a founder of a company, it can go to zero. It can go really quick to zero. I know. I've been in companies that have gone to 1.5 billion, and I've been in companies that have gone to zero. So from 20 million, 30 million. So it's important to give a discount for the institutional venture capital guys, particularly, but it doesn't matter after that.
Yeah, actually, I was going to ask Cameron if you had any differing thoughts on the valuation process there.
Yeah, early stage valuations is kind of like, it's a bit of, hey, here's how much you're raising. Typically, you're giving up between 20 to 25% of the company at each stage, and optimizing more for the type of partner. If you can get a few term sheets and then maybe you can get that down a little bit. But again, I think it's optimizing for the right partner. This is a person that can be a huge pain in the butt, and make sure that they have real, value add services or a network that can help you. I mean, for us, having been built in this ecosystem, spinning out of a firm with 2 decades of enterprise relationships, one of the things that we say is a lot of our limited partners, our investors in our funds, are executives in the region. So if you name some of the biggest companies, we got execs at those companies that are a sandbox set of customers for our startups to go sell into, and they also have great sources of talent. So if one of our companies needs to hire a VP of sales, a head of customer success, a CTO, then we go out to our network of folks in this region who love Seattle, who love the Pacific Northwest, who love the companies being built here, and they take the time to help. And so I would optimize for partner. On the valuation stuff, the seed, we're not seeing that big of a delta, maybe a little bit in the seed. The Series A is down a little bit, but the big deltas are in the growth rounds. I mean, those are significant. But the point that was made, over-indexing on valuation, as long as it's fair, is going to be more of a headache than it's worth typically.
Yeah. Kelly, would you mind sharing with us some of the current stats on valuations?
I do think it's helpful for startups to know what the market stats on valuations as they are thinking about fundraising. So for the seed round, which is raising between 2 to 10 million, the Q2 stats, the median post-money valuation was $18 million. And for Q3, PitchBook is showing that the pre-money valuation was at 10.5. So that's the valuation prior to the investors bringing money into the company. Then when we look at Series A, PitchBook data shows the year-to-date median at 55 million, and that's up from Q2, which was at 53 million, so up by 2 million there. So that's kind of a focus on the very early stage rounds.
Awesome. So we're going to move in now to considerations for debt financing. So, John, it is your time to shine. All right, so let's discuss lower prices versus a more flexible structure.
Yeah, borrowers want the highest debt quantum, the lowest price, the least amount of structure, and the least amount of dilution that they can get, which would be great in a perfect world. But it doesn't always work that way. So I had an example of a company. I think they were founded in 2015. I think they'd raised through their Series B, doing about 15 million in revenue. Really good metrics, high retention rates, low churn, just everything that you want. It was a really good company. And they were looking for some debt to extend their runway, which I think is a smart thing to do. And I gave them what I thought was a really good term sheet. My covenants, they had plenty of cushion. I mean, they would have had to just completely collapse not to have adhered to the covenants that I gave them. But heading into this environment, they were really nervous. So they opted for pure venture debt, which was probably one or no covenants, higher pricing, probably some warrants attached, only because they didn't want to have to manage their business to covenants. So it really depends on the situation. In that case, they valued structure or flexible structure over cheaper price. I think in normal times, not heading into this kind of environment, my term sheet probably would have been a better fit for them. So again, in this environment, I think companies are opting for more flexible structure, which is not necessarily a good thing for me.
Yeah. Well, on the topic of covenants, so can management confidently adhere to covenant requirements? Sorry, get tongue-tied.
Can they
confidently adhere to covenant requirements?
Sometimes they can. I think that was a great the example that I just provided. Mm-hmm. They were not confident that they could adhere to my covenants, which I thought were pretty generous. So no, not always.
All right. And then my last question for you on this is aspects of dilution for debt financing versus equity.
Well, debt financing is always going to be cheaper from a dilution standpoint. These days, I remember back in the year 2000, we were able to price credits at 6% warrants coverage, which means that the amount that we committed, we'd multiply that by 6% and divide that by the number of shares based on that last price round. Now, warrant coverage is down into the basis point range, so 50 to 25 basis points. So it's nothing. So even at that level, dilution is not nearly what it would be if it was pure equity. So debt financing is better from a dilution standpoint, but what companies have to do, they have to be able to repay it. And what we don't want to do is set a company up for failure after we close, and then 3 months later they breach a covenant, because then conversations get really ugly. I get my attention distracted and diverted to managing that credit when I should be out trying to find another borrower. So, dilution is important. You don't want to have it, but you also want to make sure that if you have sources of capital that maybe are more dilutive, but there's less restrictions, that might be the better option.
Yeah, perfect. All right. Did anybody else want to discuss on debt financing on the panel? No? All right. I didn't figure so, but I wanted to give you guys a shot. So, all right. So moving into the last topic of the night, it is preferences and participation. So I figured this one will be a real interactive one with our panel up here. So I think this one really is more Kelly and Cameron. Has negotiation leverage shifted back to investors?
So I can start this one from what we're seeing with our clients and what we're seeing in the market, as kind of I explained and Cameron mentioned as well. Like 2020 was this big boom, and it was a very, very founder-friendly market. And so there is this market correction. So it's not as founder-friendly. Investors do have a lot more leverage in the market, but it is this correction from where we were. Cameron, do you want to add anything to that?
I think about it almost as like just the slowdown and the focus on existing portfolio, the focus on higher reserves means less time and energy, less FOMO on the new investment stuff, which means it's harder to fundraise. I mean, it's always hard to fundraise. Even in the past 2 years, like it's never easy for these companies to go out and get a round done. Even our best performing companies, the best performing companies in the world, typically have to talk to a lot of different investors before they get a term sheet. So it's never as easy as it, TechCrunch or some of these other publications make it seem. But I think if you're a company that is growing 3x, you're capital efficient, and you're in the earlier stages, you're still able to get roughly around the same price. But just the fact that a lot of venture firms are so focused on their existing portfolio and the reserves management means it's a little bit harder to raise, which means maybe you have to be a bit more flexible on raising the valuation of a year ago versus today.
Thank you for that. Okay, and so my last question kind of goes out mostly to Kelly, Owen, and Cameron here, but John, please feel free to chime in if you would like. Pitfalls and traps entrepreneurs should consider before agreeing to allowing preferences in participation.
So some of the things to be aware of for startups is the liquidation preference. So there's two parts to this. One is the preference and the other part is the participation. And so the preference is what entitles the investor to be paid back before another series of stock. So if you're a founder with common stock and you bring in a founder with a Series A stock, they will have a preference that they're going to get paid back before you are paid back. So that's something to be aware of. And then the other is the participation, which will give the investor the right to be paid back more than their initial investment. So these are two things that could affect you down the line, and things to be aware of as we are going into more of an investor-friendly market.
Okay, one of the things that I didn't talk about, and I don't think my colleagues here spoke about in detail was the board of directors. And it's really important from an investment standpoint that you have a board of directors that is contemporary, is up to the minute, because there's two reasons for this. One of the reasons is these people will help you raise the capital. You're not on your own to raise the capital. These people will help you raise it. And the second reason is for investors. If the investor sees that an investor has provided capital and is also providing it again, particularly on a board of directors, they're more inclined to participate in your company. So it's really important to have a board of directors that's contemporary, that raises capital with you, and from a preference standpoint, these people will help you as well. These are different than your advisors, board of advisors. They're board of directors. They have a fiduciary responsibility to the company, and they will help you with the term sheets.
Yeah, look, for us, I mean, I've never issued a term sheet that had any sort of, liquidation preference above a 1x, and never done a participating, term sheet as well. You see that a lot in PE. You see that sometimes in growth equity, particularly now as they're doing down rounds or more structured rounds. It's a little bit, you see it less in venture, but this preference stack is, a concept that, people know how it works, but I think the hard lessons are being learned now. And what I mean by that is if you're a founder over the past few years that raised $50 million and the company sells for $50 million, you get zero, all your hard work over the past few years. And so capital was cheap. The advice you're getting from most of the people around the table was raise the money, get the capital in the bank. Money's cheap right now. Let's make sure we have a long runway. But you as the founder and the CEO, your downside, the companies has to be worth so much more for you to get even a nickel back. And so you're seeing a lot of those, hard conversations happen today. So really pay attention to this stuff. Have a great lawyer like Kelly that can make sure that you're not getting very weird terms in these term sheets, because times like this is when you start to see firms try and slip in stuff like this, and you might end up regretting it years down the line. Now, so if it's the only option, you got to keep the lights on, keep your employees, getting paid, then you got to do what you got to do. But definitely worth understanding how the funds flow works in the case of an acquisition or an outcome.
Perfect. So now we'll take some questions from the audience. We'll go right here up front.
I got one for you. That's kind of a macroeconomic question, probably more for John and Cameron. There's probably a couple of sectors or verticals out there that come out around when that recession happens. Prop tech comes to mind, fintech, funds, emerging. When you look at investments going forward, do you look at prop tech as just a job? I got to be careful with the next commercial real estate broker here, because it's so much based on transactional volume, which is just diving by market, housing purchases, or you still think there's opportunity for a good idea that's based on foreclosure or distressed? How do you view sectors that have not really withstood earlier recessions?
Yeah, we pay attention to sector diversification within our own fund quite a bit. We invest horizontal companies selling horizontally, but also vertically. So we have investments in insurance, construction, financial services, insurance, healthcare, agriculture. You go down the list, and so we want to make sure from a fund we're not getting overly concentrated in one sector that might be super correlated or uncorrelated with the market. But I think for us is whenever you have these large market shifts like this, it's where a lot of the best innovation happens. And so no matter if you're selling to a sector that might be a little bit hit hard during the pandemic, okay, maybe that raises the bar in terms of what are the key metrics that the company is going to hit. But if they have a really good idea, the right team and path to execution, we're always going to take a look at every sector. We'll never say, hey, this is if it's a core piece of software, we're never going to say because of the macro environment's down, we're not going to do it. Some of the best companies are in the world were founded post the 2000s and post 2008s. And what you find in those companies is often they're significantly more capital efficient. Viva this vertical SaaS darling raised $7 million before it went public. So you'll start to see more stories like that of companies that are, forced to do more with less because they're founded in times like this. They can go the distance on much less capital raised.
Yes. Who else do we have? Right here.
I have a question for alternative capital. Can y'all comment respectively on how you value, from a physical equity perspective, international revenue as well as cash flow? How much you just perhaps look at it at a premium and with a clear path to 10x that.
I'll start. From a debt perspective, for us, we're all about taking security interest. So we want collateral. So if we can perfect easily, if the IP is located in that country where those revenues are generated from, that's something that we can lend into. If not, the legal fees might not be worth it. So it depends on the country that we're talking about. Western Europe, probably okay. You get a little further out, that makes it a little more challenging, at least for us.
Could you ask the question again?
Yeah.
Sorry.
I'd love to get your take on how you would discount or perhaps value at a premium or just look at a company with revenues that's coming international.
Okay.
Revenues, even earnings EBITDA.
Okay.
Has a pathway plan to 10x that.
Okay. The question was, is somebody from international, what's their EBITDA? How would you value this company? How, okay. Being the sole Irish person on the board, on the panel, sorry. Are you Irish? Okay. Being one of two people who's Irish on the panel, I know that the U.S. is more sophisticated when it comes to capital, when it comes to valuing EBITDA, when it comes to debt, when it comes to institutional venture capital, it's more sophisticated. So Europe is a little behind. Rest of the world, row, is very behind. So, and it's concentrated in California where I was. It's concentrated basically in California, the venture community in California, it's a bubble. So when you go out of California to other places in the US, Boise, Idaho, for example, it's much less. They value the company much less. So I think it's really important to have equity shared amongst the founders. I've found not that case. I think it's really important to have equity shared amongst the founders, and the valuation isn't that important. Not at this stage. It's not that important. You give a discount off the valuation you're proposing. Do you want to add to it?
Yeah, and I think for us, it's like the types of customers. International versus U.S. doesn't matter, but are they a sophisticated customer? If you're a software product and you sell into Apple, well, they have one of the most sophisticated procurement departments in the world, and a lot of companies look at what they buy and then copy it. So it's more the type of customers you're selling into versus necessarily if it's international or not. So no, there's no discount from us.
Perfect. Yeah. Right over here. Yes, ma'am.
So Cameron and John touched on this a little bit, but the question's open to anyone. But being as specific as you can, how has your definition of product market fit changed from, say, this time last year to now?
So the question is, how has product fit changed?
How has the
Definition of the product fit changed?
from this time last year to now?
Yeah. You want to comment?
Don't Kelly.
I'll jump in, and so it's a really good question. I don't know if the definition has necessarily changed, but maybe the amount of capital you can raise on even achieving product market fit. I mean, we see a lot of companies where I'm like, okay, this company would have been able to raise $15 million. They have a year ago. They have product market fit. They're in an interesting space. They have a good team, and maybe product market fit, it's really dependent on the sector and type company, but maybe it's 10 customers that are all using it for a consistent use case and they love it, for example. But maybe that company could have raised $15 million a year ago, and now they're raising $6 million. And so as we talk about product market fit internally and externally, I don't think we've changed what that means, but the bar for the amount of capital that you raised a year ago is different, if that makes sense. Now it's a little confusing, but.
I would just say from a debt perspective, I don't think how we look at credit has changed, except for the fact that if the company is let me think about that for a second.
That's a good question.
Gary, do you want to add another question to the bucket? Okay, great.
With all of these different, which I would all even say big circle things, all these different ways that you can now get funding and finance your startups, how does that impact formation? And what should we consider doing that? And is it a hassle to change formation?
So if you're a company looking for VC financing, we're going to recommend that you form a Delaware C Corp. If you don't form a Delaware C Corp and then let's say you form a Washington LLC, which if you are a one-member team and you're like not really sure what the next couple of years look like, that can make sense for you. But once that VC financing is on the horizon, you can convert. It's not really a hard process. Delaware does tons of incorporations. There is going to be some additional filing fees. So that can also be a conversation that you have with your CFO, your CPA, to understand like what are the tax implications at the phase I'm at. So it's not just a legal question, but it's also a financial question. Does that answer kind of all the parts to it, or was there another part that I missed?
Yeah, no, that's great.
Yep.
But is there an impact if I was going to go get funding or crowdfunding?
I will let John and Owen maybe speak to that, of how that kind of runs down the chain.
I'll let Owen answer that question, but I wanted to get back to yours. So my brain is unfrozen. So really what we look at closely, which I didn't mention before, is a lot of the deals that we get are inbound through investor relationships we've built over a very long period of time. We were formerly a debt fund that was acquired by CIBC. That's how we got into the tech space. And so our relationships with investors are very important. In this environment, if it's not an investor that we know really well, we're probably not apt to stretch as much as we would if it was an investor that we did know well. Although they did hire me to expand the investor network, which in order for us to grow. But if it's a competitive situation and we need to stretch, we're probably not going to stretch as far if the investor syndicate is something that we're not as familiar with. So that's kind of things that have changed for us. All the other metrics that we look at are pretty much the same. We're probably not going to extend as much leverage as we did a year ago, maybe. But I think that's probably on par with a lot of our competitors. I think everybody's getting a little more conservative in this environment, and hopefully that'll change over the course of the next year.
Okay. The question that you asked about, I would engage a law firm. SSM is a great law firm to engage. But if the investor is stipulating that it needs to be a C Corp or an S Corp, LLC, whatever it is, just do it. I mean, just do it. Not want to steal Nike's terminology here, but I think it's not going to preclude investment, but it's necessary for investment to happen. So engage a law firm.
Great. Do we have any more questions? Yeah.
Alternative forms of capital, human capital, in terms of economic looks like in kind of your forecasting going forward and how that affects overall growth. Are there any conversations or points you've had that you're willing to share about what that looks like going forward for these companies?
Yeah, you know, it's funny. We were just talking about this. You know, we across the portfolio, we haven't seen the cost come down over the past year of hiring people. What we have seen is they're able to get better access to talent. And so if you're a talented person and you want to work at, doesn't matter what stage, you know, these public companies, the S&P has been going up by 25% or something year over year for the past 3 years. These public tech stocks seemingly had never looked like they were coming down. You can make a lot of money at these businesses. Now the world is flipped upside down, right? To where these comps have come down by over 2/3, as I mentioned, some significantly more. And so they're open to and looking for going to a better risk-adjusted potential return, which is earlier stage. So why not go to a company that was recently valued between, call it 20 million and 100 that has real revenue that I don't think is super overfunded. All right, I'm going to go work there. And I think the upside that I'll get from the equity from that business is going to be way higher than even risk adjusted than a public technology company or even a late stage private technology company. But we haven't seen the actual cost to hire these folks come down yet. Maybe that'll change as layoffs potentially continue through Q4 and into Q1. But you're able to get access to some pretty incredible folks that a year ago wouldn't have thought about joining a Series A or B or C stage company.
All right. Well, I think that concludes the evening or the panel for now. We do have this room for the next hour. So if you have any other questions that you want to bring up with the panel, please do. Thank you guys so much for doing this for us tonight. And thank you guys for coming. I really appreciate it. I've had a lot of fun and I've learned a lot from you guys. Oh, and please take some of the food home. Like, eat food. All right.
Yeah.